Hi, welcome to our discussion of Goodwill. In this module we're going to be discussing what Goodwill is and what the accounting implications are of Goodwill. So first of all, Goodwill is not a very good accounting term. It lacks precision. When we think of Goodwill, we probably aren't thinking of what the accounting term really means. So the preferred accounting term these days for Goodwill is cost in excess of the value of net assets acquired, which is kind of a mouthful, but it's far more descriptive. Okay, Goodwill is not kind of a fluffy feeling that our customers get when they think of the company. It's not a charity. Goodwill arises basically only when a company is purchased at a cost in excess of the value of its net assets. So for purposes of illustration, let's assume that company A purchases another company called company B. And company B has assets of $10 million. It has liabilities of $5 million. And thus net assets, which is simply assets minus liabilities, are valued at $5 million. And in purchase accounting, when you buy another company, all assets and liabilities are marked to market, so we can assume that these represent the market value of the company's assets and liabilities. So the company has assets and liabilities that are worth a net of $5 million. Let's assume that company A paid $6 million to acquire company B. Well, the cost in excess of the value of the net assets acquired is, in this case, clearly $1 million. $6 million was paid. The net assets were worth $5 million. Difference is $1 million. So that creates $1 million worth of goodwill on company B's books, or company A's books, excuse me. Company B, of course, ceases to exist once it's acquired. Well, that's what goodwill is, but why? Let's ask ourselves the question, why would company A spend an extra $1 million to buy company B over the value of its assets? And the answer is, well, they must think there's something good about company B. And they must think that that good thing is that company B can create earnings in excess of the cost of capital. We discussed this a little bit early on in the semester. The cost of capital is simply the return that shareholders want to earn. So let's say that we believe that a good cost of capital for company B is 10%. So we'll put 10% down, or 0.1. Oops, let's change the format so that we can record that. Okay, so our cost of capital is 10%. So if we're going to spend $5 million and we want a minimum 10% return, we would expect to get a return every year of something around $500,000. Okay, $5 million that we're going to spend times our 10% cost of capital, $500,000. Well, let's say that we believe, after acquiring company B, that we can earn more than $500,000. Let's say that we think we can earn another $100,000 a year forever. So we believe there's extra earnings of $100,000 a year, or a total of $600,000. Well, how much will we pay, the question is, for this extra $100,000 of earnings? We're willing to pay $5 million for $500,000 a year of earnings, assuming it lasts forever, which is not realistic, but for purposes of illustrating, this is reasonable. How much are we willing to pay for that extra $100,000 of earnings? And if we created goodwill of $1 million, the answer is we must have been willing to pay an extra $1 million for it, which is a 10% return on our $1 million into perpetuity. This is why goodwill gets created. Goodwill is created because we're willing to pay something for the excess earnings capacity of company B. That earnings capacity has value. Okay? So the total value we assign to company B in this case is $6 million, which includes an extra $1 million of goodwill. This will hopefully become a little more clear when we start to discuss present values in the future. But basically, the price of any financial instrument, including a share of stock, is the present value of its future cash flows, discounted at the company's cost of capital, or the appropriate cost of capital in the case of a debt instrument. So if we were to take $600,000 a year, the present value of $600,000 a year into perpetuity would be 600,000 divided by 10%. That's the way to determine a present value for a stream of cash flows that lasts forever. So 600,000 divided by 10% is equal to, obviously in this case, $6 million. Okay, so that's the present value. That's what we were willing to pay. So if we pay that, we get exactly a 10% return, assuming that it earns exactly $600,000 a year forever. Now, obviously, what can go wrong with goodwill? We can be wrong about our earnings assessment. It could earn more, it could earn less. So the book talks about impairment of goodwill. When does goodwill become impaired? And the basic answer is it becomes impaired when this earnings stream that we believed that we were going to obtain from the purchase is less than what we thought it was going to be. That represents an impairment of goodwill. And if goodwill becomes impaired, we have to write it down to its fair value. Fair value, once again, is an accounting term that we can kind of associate with market value. We have to write it down to what it's really worth. Okay. So if it turns out that we believe we're only going to get $500,000 a year forever, that means the company was really only worth $5 million. So therefore, all of the goodwill, or $1 million, should be written down. Okay. So how do we account for goodwill? Well, when company A acquires company B, it would put all the assets on the books. So it would debit various asset accounts, cash, accounts receivable, inventory, at their fair value of $10 million. Oops. It would credit all the liabilities, notes payable, accounts payable, salaries payable. So it would credit various liability accounts. Let's move it over a little bit to credit it for $5 million. It would credit cash for the $5 million it paid, or for the $6 million it paid, sorry. Which leaves us with $10 million worth of debits, $11 million worth of credits, and to make this balance, we need another $1 million worth of debits, which of course is the goodwill account that we just created, debit to goodwill. Okay, so that's how the initial purchase is accounted for on Company A's books. In the event that the goodwill was impaired, we would debit an impairment loss for $1 million, and we would credit the asset account goodwill. Goodwill, of course, is an asset that doesn't amortize, one of the few intangible assets, or the only intangible asset that I'm aware of anyway, that doesn't amortize. Instead of amortizing, it's subject to this impairment test. Okay, so in a nutshell, that's accounting for goodwill. Thanks for viewing this.